Welcome everyone, and we are back with another topic from your SBL syllabus, which actually has a lot of overlap with what you will study in AAA in case you pick that paper up. And as students of commerce, as students of ACCA, and as future leaders of the business, you should know the concept of corporate governance in its entirety. It's not just a tool that will help you in the exam, but it is also a tool that will shape you into a better professional every day. So let's spend some time understanding corporate governance today. I'm sure you have heard the term corporate governance, right, in discussions on social media, but what does it really mean? In simple words, corporate governance is the system by which companies are directed and controlled. Basically, someone laying down guidelines for the company in terms of how you should work. Okay, so these are the principles of rules, ethics, practices, processes that basically ensure accountability, fairness, and transparency in a company's relationship with all its stakeholders. It could be shareholders, management, customer, employee, lender, regulator, or the society at large. It could be anyone. But what are those principles of good corporate behavior? Like when you are a kid, your mother tells you, please get up early in the morning, exercise, study properly, eat the right food. Is it a crime to get up late? Well, I'm not asking Indian mothers. I'm just asking, is it a crime to get up late? Will you be put behind bars? No. Is it a crime to eat junk food? No. But these are certain rules and regulations. I wouldn't even say rules and regulations. These are certain guidelines that have been laid down to ensure that your functioning as an individual happens properly. Similarly, these guidelines, practices, processes, this entire framework that we create for companies is called the corporate governance framework. Now, understand it's not a law, okay? Like you have Companies Act 2013, it is a law. Corporate governance is not a law. Corporate governance is basically everything that you do which is necessary for proper, smooth, and ethical functioning of the business. Let's call it that way. And to understand why corporate governance matters, let's look at one of the biggest scandals that shook India in the last 20 years, and I'm talking about the Satyam scam. See, Satyam Computers was once called India's Enron. I mean, look at the irony of it. It was really a fast-growing IT company ranked top in the industry, but in Jan 2009, its chairman Ramalinga Raju, he confessed that he had been inflating revenues and profits for years. He admitted that nearly 7,000 crore of companies' cash and bank balances were fictitious. Now, the question is, how come auditors who were chartered accountants who were trained to basically detect these flaws, how come they were not able to detect it? I mean, it must have taken some another level of intellectual mastermind to pull something like this off, but at the same time, it called into question the ethical compatibility of all those involved. Right. I mean, it's okay to, I mean, not okay, but I can still understand why you could not detect some uh, misappropriation or say misstatement of revenue. But how can you not know that about cash and bank balances? I mean, it's scary. And everybody had failed to detect the fraud. And what was the result? The shareholder wealth evaporated, employees lost their jobs, everyone panicked, and it created a problem for us on a global level because now India's reputation as, a tech support ecosystem or a tech ecosystem or an outsourcing hub was, it had suffered internationally. I mean, it shook investors' confidence to such a level that, back in the day when I was working with EY and we had Tech Mahindra as one of the clients, Tech Mahindra, Satyam had become Tech Mahindra. So everybody used to joke around with me that don't tell them your name is Satyam because anyone with that initial is even banned from the very premises. Now let's contrast this with someone like Infosys, another IT giant, but it has a very different backstory. Infosys has been consistently admired for its high standards of governance and one of the first companies to adopt international reporting standards, to have truly independent directors, and to build a reputation for transparency. When foreign investors look at India, Infosys could be cited or is often cited as the benchmark for good corporate governance. In short, corporate governance can make or break your reputation, and it is critical for long term survival. And what all are, would you say, the foundations of effective corporate governance? As you can see on screen, the first one is the agency relationship. We have discussed agency relationship earlier. Let's recap that. See, The agency relationship stems from the fact that the owners of the company, who are the shareholders, they cannot participate in the day-to-day running of the company, and they don't have the knowledge or the time or the ability to execute that. So they appoint people who are called the directors to run the company on their behalf. Okay. Now, the people owning the company are different, the people running the company are different, and the people running the company, because they are human at the end of the day, would try to get things for their own benefit, even if it is to the detriment of the company. So instead of focusing on maximizing wealth of shareholders, they will just focus on improving their own personal stature and their own personal wealth. I mean, think of Yes Bank. Okay. Yes Bank, again celebrated as one of the fastest growing private sector banks under the leadership of Rana Kapoor. It soon became clear that aggressive lending decisions were being made without adequate risk controls. Not checking for collateral, not checking the background, not conducting due diligence. You think about a flaw and it was already there. Now, there was a large exposure to weak companies, which meant that the bad loans were piling up. Eventually, the bank had to be bailed out by the government and the State Bank of India. I mean, I own shares of Yes Bank. I know how painful it is to be owning that share right now. Shareholders lost heavily. And again, the question was, where was governance? How was this company functioning? Why didn't the directors or institutional investors stop management from taking these kind of risks? They were playing a gamble, but it was ultimately to the detriment of shareholders, right? Which is why you need corporate governance frameworks to make sure that managers, who are the agents, or the directors, who are the agents, act in the interest of the owners and basically in the interest of all the stakeholders, not just for their own personal gains. They cannot use it as their personal gambling den to make more money, right? So naturally, these problems come up, and it damages the reputation of the company, it damages shareholder wealth, it damages everything. And if the company is big enough now, it can damage fabric the fabric of trust that is placed on that company, and the economy might suffer as a result. Then let's talk about stakeholder management. Why stakeholder management is the bedrock on which effective corporate governance rests. I mean, see, it's not about just shareholders and managers, right? There are multiple stakeholders: employees, customers, suppliers, creditors, regulators, the community in which you operate. And a good governance framework ensures that everyone's needs are balanced and taken care of. Look at the Tata Group. For over 150 years, they have built a reputation for not only running profitable businesses, but also caring deeply about employees and the community. So, two-thirds of Tata Sons, the holding company, is owned by a charitable trust. This means that a large portion of profits goes back into social causes like healthcare, education, rural development. And then there are companies which focus on short-term returns for shareholders while ignoring the employees or ignoring the environment in the long run. So these companies, one fine day, people will see it for what it is, and they will lose the public trust and that competitive edge as well. So keeping all the stakeholders satisfied and balancing their needs is at the very heart of corporate governance. CSR is not far off. See, corporate social responsibility, I would say, is also linked to, not just planting trees, or not just healthcare in a very informal manner, but Companies Act 2013 has made it mandatory for certain companies above a particular threshold to spend at least 2% of their average net profits on CSR initiatives. See, it's about reputation, it's about brand value, but it's something that should come from within, right? A great example of this is ITC's e-Chopal initiative. So what ITC has done is they have set up internet kiosks, like, a kiosk could be considered like a makeshift shop, like a thela, giving farmers direct access to market prices, weather forecast, and best practices. Because a lot of the input of ITC comes from the farmers and from these places. So it has empowered the farmers, and it has also created a stronger supply chain for ITC. So on one hand, farmers are benefiting, because they are getting the right price for their output. They don't have to deal with middlemen, and it is helping ITC also. I mean, it's a win-win situation, right? Hindustan Unilever, they have projects like Project Shakti, which empower rural women to become direct-to-home distributors, women making papad, achar, homemade jams, ketchups, giving them direct access to customers. And that has basically helped these women entrepreneurs also, and it has definitely strengthened the company's image also, and the supply chain as well. So it's not as if corporate governance is restricted only to having, like an independent audit committee. Okay, it's not that. It's not just relating to having a remuneration committee, but it is like a full-fledged approach to doing better, sustainable business on a daily basis. Okay, now having understood what is corporate governance, let's understand who exactly are institutional investors and what role do they play. It's an important topic in corporate governance today. Who exactly are institutional investors? They are large organizations that pool money from savers and invest it into stocks, bonds, real estate, or other financial instruments. I mean, think of ICICI Prudential Mutual Fund. You, me, thousands of us are, making SIPs or lump sum mutual fund investments every day. And ICICI Prudential Mutual Fund now has a huge amount of capital. It will invest in different companies. It will invest in Zomato. It will invest in Hindustan Unilever. It will invest in multiple such companies. Right. LIC, Life Insurance Corporation of India. It is one of the largest institutional investors and it has holdings worth lakhs and crores of rupees across companies. So when LIC invests or exits a company, it sends a strong signal to the market. Right. So the market will look at what LIC is doing, because if LIC is making a decision to invest in a company, then yes, it is a sound decision. And if LIC is exiting a company, it might send shockwaves or it might signal something else to the investors altogether. Something like BlackRock, the world's largest asset management company, which has around $9 trillion under management. It also engages directly with companies. It holds a large stake in these companies. And of course, it has inputs on how the companies are run, sustainability, board composition, everything. So their decisions will often shape corporate strategies. And right now, institutional investors are not passive spectators sitting in the background, expecting the company to do its own thing and only taking their dividend and profit and going home happily. That's not the case. They are now participators in nation building. They are participators in corporate governance as well. They vote on key issues and they ask for very critical questions. I mean, LIC, an insurance company, I told you, is one of the biggest examples of insurance investors. Mutual funds, ICICI Prudential Mutual Fund, BlackRock, which has, as I told you, $9 trillion under management. Pension funds, because pension funds, like I am invest, like a part of my income is going to a pension fund every month, and that money is going to be paid to me only after I retire. So it has around like 30 years to still use that money in different ways. So these pension funds will invest in large companies and make money from that. The proportion of institutional investors in the overall capital structure has only gone up in the last couple of years. Okay. And when we talk about insurance companies, when we talk about who are some of the biggest players in as institutional investors, I think insurance companies, pension funds, and mutual funds will take the cake in, in being institutional investors and making large chunks of investment in companies across the world. Now, earlier, the ownership of companies was dispersed. You had a lot of individual retail investors, but over time, the institutional investors have come to dominate. If you look at the New York Stock Exchange data, institutional ownership or institutional investors' ownership has grown from 7% in the 1950s to around 67% by 2010s. We have seen that shift in India also. Foreign institutional investors and domestic institutional investors, they own significant stakes in, companies like Reliance, Infosys, HDFC Bank, ICICI Bank, which is why when there are global tensions and, India introduces maybe a tax regime that doesn't suit them, or, there are other challenges on the global concern, you will see foreign institutional investors suddenly withdrawing themselves from the market. And that leads to a fall in share price because they own like such a big lump sum of shares that a sale from institutional investors is going to trigger market panic, and which is why companies cannot afford to ignore the institutional investors anymore. These institutional investors play a critical role when it comes to corporate governance. I mean, their first job is performance monitoring. They track financial and operational performance more rigorously than small investors. See, I own 50 shares of Reliance, for example. Even if Reliance has a massive profit, I know I'm going to get a very small portion of it. Even if it gives a dividend of 5 rupees per share, I have 50 shares. What does that mean? 250 rupees dividend. I don't really care too much for it. But an institutional investor owns 50 lakh shares in Reliance or 5 crore shares of Reliance, and a dividend of 5 crore into 525 crores dividend is going to this particular company. So naturally, they are going to track the financial performance with a fine tooth comb. And even the day-to-day workings, they will be interested in that. See, which is why their role, they are the most concerned about the performance of the company. So they will always be tracking it with the minutest detail. Second role that they play is that of board oversight. Institutional investors demand that boards are independent, skilled, and diverse. I mean, LIC, for companies like LIC, which are LIC is one of the biggest institutional investors, and they are major holders in companies like ITC. They do influence the board composition. They appoint their members. They appoint individuals, who have true capability to be independent and look at the company from a third eye, third person perspective, zoom out and focus on the bigger challenges instead of, getting caught up with the mundane. The third one is, of course, shareholder voting. Right now, institutional investors participate actively in AGMs and vote on issues like, if executive pay, that is pay of directors, if there are any further acquisitions that the company is planning, they will vote on that. They have a role to play in auditor appointment. And uh, a high profile case that, Tesla shareholders pushed back Elon Musk's massive compensation package, forcing a debate on whether it was justified or not. So they are not just sitting in a lame manner and, allowing things to function as they are. They are playing a critical role in ensuring that no executive or no director gets a pay which is disproportionate to the work that he is doing, and there is effective voting on all critical matters. The board oversight is also maintained. And it right now, the way institutional investors are functioning, now they have an active governance engagement. I mean, I'll go back to the example of BlackRock. They hold thousands of meetings every year with companies around the world, including Indian firms, because BlackRock has invested in almost every company under the sun, directly or indirectly. It's huge. And they don't discuss profits, just profits. They don't discuss just wealth. They are discussing board diversity. They are discussing representation. They are discussing climate risks, and they are discussing human capital management. And if engagement doesn't work, they have the ultimate weapon. They can sell their stake. And the very fact that, if someone like BlackRock is planning to sell the stake in your company, you know that it is going to send shockwaves across the market. And even if nothing is wrong with you, retail shareholders will see that as some sort of an issue, that is the signal it will send to them, and they will also start panic selling. So it's not as if the company is immune. The company has to make sure that it engages with the institutional investors on these points. I mean, the Hindenburg report, if you remember, it raised governance concerns about the Adani group. Foreign institutional investors started selling their shares, and it led to a massive fall in share prices. So everyone's literally under the radar. And this active governance engagement by institutional investors is creating the right atmosphere. With $9.42 trillion assets under management, the BlackRock team is answerable to millions of investors, right from the smallest retail investor to the biggest individual HNI, high net worth individual. So ultimately, the focus of a company of a investment management firm like BlackRock is not just on profits, it's on sustainability, it's on promoting good corporate governance, it's on creating an atmosphere of trust and transparency, ensuring that businesses function in an appropriate manner, in an almost textbook like fashion, without impairing the ability of the business to generate future profits. So I think what BlackRock's position in the market, I think, could be a great case study for all of us to understand. But there are certain problems with institutional ownership. It's not as if, it's completely above board. For example, there could be misaligned incentives. Fund managers are rewarded on the basis of the size of assets under management, not necessarily on performance. So, in some cases, they might not spend time on monitoring the profitability or monitoring these governance issues. They just want to increase the base of assets that they are controlling. There could be a conflict of interest. For example, a fund owned by a bank might hesitate to vote against a borrower company where the bank has a lending exposure. See, they are all interconnected now. There is a bank, like State Bank of India. State Bank of India, there is State Bank Mutual Fund. State Bank Mutual Fund has invested in, say, for example, Adani Group. Now, if they highlight concerns in the Adani Group, the share prices of Adani will tumble, it will fall down. The market trust in this particular company will go for a toss. If that is the case, then State Bank of India, which is the primary lender, might face challenges in recovering its own loan. So, there might be this conflict of interest, and SBI Mutual Fund, although it is an institutional investor, will sit quietly. Then the very famous index tracking behavior. Many funds are simply designed to mirror indices like Nifty 50. Now, this means that they may continue investing in a poorly governed company just because it is a part of the index. Now, like Yes Bank, for example, it remained in Nifty even after the corporate governance issues had become apparent. And yet, institutional investors continued to hold their shares in Yes Bank because they had a very simple vision that if it is a part of the Nifty 50 index, then it has to be clear. And these could just be minor distractions. See, institutional investors can be powerful guardians of governance. Nobody is questioning that. They can be the custodians of ensuring good corporate governance. But we also have to be aware of the great limitations that we are facing. Also, monitoring costs could be huge because if again I'll go back to BlackRock. Imagine the number of companies BlackRock is invested in. Now, if I have investments worth, say, for example, 50 lakhs, it's difficult for me to track the performance of each fund, each asset, just with 50 lakh rupees. Imagine what someone like BlackRock is facing, $9.42 trillion. So it must have invested in so many companies. Look at the amount of exposure. How do you track the performance of so many companies on a daily basis? There's a huge cost involved. Sometimes there could be a short-term focus on generating immediate returns while ignoring, what long-term value creation is possible. So that strategic thinking is out of the window. Which is why, as we said, corporate governance is not without its limitations, but it can often be viewed as the starting point of good corporate governance. And you can consider them or you can treat them as the custodians of good corporate behavior. With that in mind, we can now move on to the next discussion, which is basically the insider and outsider systems. Now, what is the insider system? Let's see this from the perspective of ownership and governance. Okay, insider systems are common in Asia, Europe, and Latin America. Here, companies are controlled by families, banks, or governments. I mean, look at the biggest corporates in India: Tata, Birla, Reliance, Adani. They follow this insider model. The advantage is that families think long term. Mukesh Ambani's investment in Jio is not about short term profits, it is a massive long term bet which truly has transformed India's digital landscape. But there are disadvantages also. Institutional invest or insiders control can lead to abuse of power, suppression of minority interests, shareholders getting affected, minority shareholders, or tunneling, where resources are shifted to benefit the controlling families. Many mid-cap Indian family firms have faced criticism, but they are generating massive wealth, they are generating employment, and although they are mostly family owned companies, yet they have been instrumental in changing the corporate landscape and growth in India. Outsider systems, on the other hand, are seen in the United States and United Kingdom. Ownership is dispersed amongst many institutional investors, and professional managers run the company. Okay. I mean, if I were to talk of insider systems, it's in Asia, it's in parts of Europe, it's in Germany, Sweden, Italy, and all of these, where family control dominates, like the Agnelli family in Italy maintaining generational influence over so many corporations. I mean, some of the biggest fashion houses are family-owned businesses. In France, for example, the government plays a large role in so many entities and corporations. And in Germany, banks and institutional firms serve as main shareholders, creating close relationships and long-term strategic focus. In the insider system, of course, there is reduced agency problem because the owners are the ones running the business. The family presence promotes a long-term commitment to value creation. And then there is stronger ethical background because family reputation is up above all for these people. But there are disadvantages as we discussed. Minority rights may be threatened, minority shareholders. What it could lead to is transferring value to benefit the controlling families. Then it could lead to power abuse also, or management being reluctant to recruit external talent. Outsider systems, on the other hand, as we discussed, are primarily seen in the United States and the United Kingdom, and these super advanced economies, so to say. So it separates ownership and control. Agency problem arises, but there are professional managers running the company, which is owned by dispersed set of outside shareholders. So there is a stronger protection for minority interests. You have more independent boards. They have stronger legal and governance protection for all shareholders. There is a possibility, that the whole decision-making process is democratic because shareholders are truly dispersed and it could lead to enhanced transparency. See, there are agency problems. We cannot align that. There could be misalignment between management and shareholder interests, which is why institutional investors will play a role. But if they are also short term, if they have a short term vision, then it might not really benefit the business the way we expect it to. With that in mind, after having looked at the role of institutional investors, the role of or what are insider and outsider systems, let's spend some time understanding the principles based approach versus the rules based approach. Now, two foundational elements shape corporate governance. Okay. The legal and business culture. The development of corporate governance code has been fundamentally influenced by the legal traditions and business practices of different jurisdictions. Now, the cultural outlook of that particular country, the approach of that, the overall approach of people in that country, that will shape corporate governance. So you could have a so that has a major role in deciding ultimately what will make it to the list of good corporate practices. And you have two different ways of looking at corporate governance. There is the principles based approach versus the rules based approach. A principles based approach focuses on broad objectives rather than rigid laws. The UK Corporate Governance Code is an example of that. India also follows it to a certain extent. See, SEBI regulations and the concept of comply or explain. Companies must either comply with governance requirements or be able to explain why they haven't been able to do that. It is flexible because it tries to serve a bigger purpose without putting too much pressure on, following the law to the letter, but following the spirit of the law is what the focus is all on. Also, with, corporate governance systems gaining traction in India, I think the entire approach is now changing. We are moving from we are more focused on, having a principle led approach where the broad outline is given so that the coverage is more. On the other hand, in a country like the United States, for example, they have a rules based approach which is far more strict. The benefit with a principles based approach is that, it has universal application. The principles can be adopted and adapted to the current situation, and the framework is a little more adaptive. There is the comply or explain approach that we discussed. So companies are expected to faithfully comply with the corporate governance requirement or provide detailed explanation for any non-compliance. This approach creates powerful incentives for adherence while maintaining flexibility for legitimate business reasons. So see, the principles based approach means you don't have exactly codified rules, but it could be something like, making a statement, stealing is bad. Now, stealing anything is bad. That is the principles based approach. Under the rules based approach, you will have something like stealing these 20 things is bad. So, if you end up stealing the 21st thing, then you are not caught by the law. Principles based approach just makes a broad statement, stealing is bad, and then you will face consequences for literally stealing anything. The basis for this setup is that you should comply with the requirements of corporate governance, and if you can't, it is incumbent on you to explain why you are not able to. The advantages of principal system comes from, it being a flexible application, and you are following the spirit of the law and not necessarily following every single word, but you are trying to understand the meaning with which it was created so that you can cover all situations. Also, it is far more cost efficient because there is no regulation overload and it can quickly adapt to the changes taking place in the environment. So, in a compliance based approach, see, it's not voluntary, okay? In a principles based approach, compliance is not voluntary. Everyone has to follow, but it is neither a passive obligation. They have to adhere to this network, but nobody will hold you responsible as long as you are operating within the framework. There are certain criticisms of this approach that there are times when you don't have appropriate guidance available because the principle is created and interpretation notes are not provided, or sometimes the principles could turn out to be vague, or the situation is so unique that the principles might not apply in toto, and that could create some concerns in application. There could be hidden rules, and people could make use of the loopholes to get ahead of that, or the government itself or the corporate governance principles might give the regulatory authorities a sort of an upper hand if they want to persecute a particular entity. And then companies seeking stock market listings may be uncertain about the comply or explain framework, and they might feel that the mandate part of it comes at a certain cost. And see, it depends a lot on then companies motivation to get certain things right. And that is where the now it's incumbent on the company. It has to come from within if they want to honor the principles, if they want to honor the requirements of corporate governance. Because the principles are flexible, there could be a situation where people take undue advantage of the flexibility as well. Let's talk about the International Corporate Governance Framework. Founded in 1995 by institutional investors, it represents investors, companies, financial intermediaries, and parties, who are basically interested in developing the idea of corporate governance and pushing its agenda across the world. So, to promote effective standards of corporate governance, all of them have come together and they wish to advance more efficiency in the markets and foster sustainable economies across the world. Now, the ICGN committee structure is basically it consists of uh, stakeholders from all of these different bodies, and it operates through specialized committees addressing governance areas like cross-border voting practices, anti-corruption practices, executive remuneration, director and shareholder engagement, non-financial business reporting committees, shareholders right committees working for the benefits of minority shareholders, so on and so forth. Concepts which we are anyway going to take up in the next chapter. The ICGN Global Governance Principles and the most updated edition speaks about the role of board in building long-term interest for the stakeholders and working with due care and diligence, having clarity and balance in the board and executive roles, having higher standards of business ethics and functioning in a manner which is truly beneficial for the stakeholders, and having the right mix of knowledge, independence and diversity so that you have a balanced decision making perspective available. Apart from that, the focus is also on risk oversight, proactively identifying the risks in the company and working on mitigation of these risks. It could be business risk, foreign exchange risk, financial risk, or reputational risk, anything and everything. Then the remuneration, making sure that remuneration packages of executive directors are not excessive in proportion to the work that they are doing, focusing on timely financial disclosure of financial performance, financial reporting, and working on the audit aspect as well, and protection of shareholders' rights, especially that of the minority shareholders. The ICGN Global Stewardship Principles of Internal Governance, Policy Development, Company Monitoring, and Active Government have also created a better working atmosphere for all the corporates and the stakeholders who are connected with them. By internal governance, what do we mean? Review your own governance practices for consistency. Make sure that your practices are aligned with the gold standard and you do not deviate from them. Policy development, develop and implement comprehensive stewardship policies. See, good governance will attract good business. If good governance will attract good talent, good customers, so it's all interconnected. company monitoring, exercising diligence in monitoring portfolio companies on a regular basis, and active engagement with the company so as to preserve and enhance value. Now, while we had started off with the discussion of the principles based approach, we had left out the rules based approach for last. And what does the rules based approach deal with? It talks about, the approach in the United States, for example, after the fall of clients like Enron and WorldCom, US Congress passed the Sarbanes-Oxley Act in 2002, which is a rules based approach, very strict, very rigid, highly penal consequences present, which is in stark contrast to the principles based approach. It is legally binding, there are severe penalties, and there's a huge checklist of things that the companies have to follow, and that makes the targets very, very specific. That makes the compliance points also very rigid, but it ensures that companies act within the parameters that have been set for them. Now, if we were to compare the principles based approach versus the rules based approach, I think the rules based approach has its own advantages, and which is, one single set of rules and regulations, no scope for interpretation, legally binding and severe. But the one size fits all approach might create a problem, because what might be applicable for a software company will not be applicable for a agricultural company in the same way. The rigid rules may leave a lot of gaps, and there could be a lack of flexibility. And of course, these are the challenges that we'll have to face under the rules based approach, as it were. Choosing the right approach depends on the cultural setup of your country, of the atmosphere in which you are operating, the political pressures, and the market context. So, rules based approach provides quick fixes when the public trust is lost. So, when public trust is massively impaired, having a rigid rules based approach can help you to restore public faith in corporates. Heavily regulated environments or authoritarian governments, they tend to favor rules based approaches. India is not that, because we are trying to decriminalize a lot of our laws, and it's, see, the principles based approach works in economies which have reached a higher level of maturity, maybe someone like a Japan, but not applicable in all the countries. So the choice of the right approach will depend upon all of these factors. The next discussion that we have will build upon these principles relating to remuneration committee, audit committee, and the composition of board of directors. Thank you.